Hi everyone, welcome to my channel. In this video, I'll discuss how Warren Buffett is preparing for another stock market crash and why there may be another crash coming in the next few months. When it comes to looking at the stock market or the economy, one of the go-to guys that a lot of investors look at is Warren Buffett. In his latest annual shareholder meeting, Buffett talks about the economy, the stock market, and the stocks he's buying and selling. But the unique thing about this meeting was that he wasn't buying any stocks in 2020, and his company, Berkshire Hathaway, has been a net seller of stocks. In March, he sold his investments in the four major airlines, which was Delta, Southwest Airlines, American Airlines, and United Airlines. And he himself admitted that he had made a mistake and also that the airline industry will completely change as we go through COVID-19. And Warren didn't just stop there. He also sold his other positions mainly in banks. He sold 84% of his investment in Goldman Sachs and trimmed his position in JP Morgan. Buffett famously acquired his stake in Goldman Sachs during the 2008 financial crisis when he invested $5 billion into it. And in the annual meeting, he said that he rarely trims positions. So if he sells something, he will probably sell everything. He nearly sold 84% of the bank and also sold another bank, which is JP Morgan. He didn't entirely sell this one, but trimmed his position by 3%, but fully exited positions in the insurance giant Traveler and energy company Phillips 66. So in short, he's doing a lot of selling, not just in the airline industry, but in a wide range of industries from banking to insurance to energy. But I was gobsmacked by the fact that he trimmed his position in the e-commerce giant Amazon, but only by a very tiny amount, by less than 1%, which is quite interesting as Amazon is at an all-time high and Berkshire still cut its position. What Berkshire did buy was PNC Financial Group, but overall Berkshire did an inordinate amount of selling. And this probably caused their cash pile to rise from $125 billion to $137 billion, which is the largest amount of cash Buffett has ever held. So he has a ton of cash and he wouldn't just sell his investment for more cash as he's already cash rich. So we can conclude that Warren Buffett expects another stock market crash. He also said he did not buy anything during the dip in March 2020, and this could be because he expects the stock market to dip lower, or he still thinks that the stock market is generally overvalued. He says that he doesn't time the market, but does tend to invest in companies at good value, rather than look at the economy. He's a firm believer that buy and hold is the best strategy. However, his actions are telling us that he's expecting something severe to happen in the stock market. Perhaps another crash. There are talks of another depression caused by COVID-19. And it is not just Warren Buffett. There are also other investors that are bracing for steep falls in stocks. Carl Icahn is also predicting another stock market crash and he's shorting real estate. The billionaire investors are holding on to the largest amount of cash they've ever had, and how successful and well informed they are, it is not likely that they are wrong. They can be, but it's highly unlikely, and it's important to be aware of what these people are doing. If you had copied Warren Buffett and bought shares, for example, in the airline stocks, you may have lost out by a huge amount. It doesn't make much of a difference to Buffett as it's a small loss to him, but for the average retail investor, it can be huge. But it is important to be aware of what these investors are doing, as they are aware of things that we're not. On the flip side, there are investors who are buying like George Soros, who bought Disney and Pelton shares, and just looking at, for example, what a lot of investors are buying, Disney seems to stand out in the past couple of months. Sort of a mixed bag. Some investors think the stock market will rise, some think it will fall. Now, in terms of why Warren Buffett thinks the stock market will fall is because of his famous indicator, which he calls one of the most important indicators he uses to show whether the market is undervalued or overvalued. And the indicator is quite simple. It is simply the total market cap over GDP. And Buffett has used it throughout his career, and he calls it a very strong warning signal and has said it is the best single measure of where valuations stand at any given moment. So we can say it is a very important indicator. So how this indicator works, when the stock market cap over GDP exceeds 100%, that means the stock market is overvalued. So how does that work? The theory is that if the stock market cap is too low, the excess capital in the economy will fill the gap and prices will rise. The country is fundamentally rich enough to afford more investments in the stock market and prices of these securities will rise. In contrast, the stock market price is too high when the GDP is relatively low. The economy is not well off enough to support continued investments in the stock market at the price levels. Underlying this theory is that the stock market is a reflection on the ability of the economy to produce cash and returns for investors. To be more concrete, if the stock market is below 50% of GDP, it is way too low. If it is between 75% and 90% of GDP, the market is about right. If the stock market cap is above 115%, it is overvalued on a relative basis. Currently, the indicator is at 180%. So based on this indicator, we are way overvalued. Also, this indicator could go even higher as the US GDP is expected to shrink in the next few quarters. This is probably one of the main reasons why Buffett thinks the stock market will crash again. Does this mean the stock market will definitely crash? Well, absolutely not. According to Buffett, the market does not need to crash or rise dramatically to accord with this indicator. However, over the long term, the stock market returns will tend to even out. And at this rate, the market is expected to return minus 1.5% per year over the next 10 years according to Buffett's indicator. It's also worth noting that relative to other investments like fixed income, the stock market could still be considered relatively cheap or at least fairly valued. So how can we use Buffett's indicator? Rather than ringing an alarm bell, an investor has several ways to deal with this problem. First and foremost, they can use the same indicator to identify countries that have undervalued stock markets. They can easily buy the indexes of those countries and expect decent long-term returns. There are several countries in Asia and South America that still have way undervalued stock markets. Secondly, investors can take the principle of Buffett's indicator and narrow them down to individual sectors or companies. Perhaps there is a company that is issuing a much higher amount of dividends than its peers. This firm is likely to rise in value. Similarly, if one sector of the economy has a lower market value relative to its historical value, it is likely to rise. For example, currently the technology stocks are providing most of the stock market gains. So even though the stock market as a whole has been rising, certain sectors have lagged behind. Investors can identify sectors that are relatively lagging even though their performance is good. They may perform better in the future. But even though this indicator is very important and it has a good track record of predicting when the next stock market crash will happen, it does not include one very important factor, which is interest rates. Warren Buffett has said that when interest rates are low or interest rates fall, stocks become cheaper and are more attractive. And right now we are at the lowest interest rates we have ever been. So when we take this into account, things look a little different. So here we've got the Brock value, which takes into account GDP and interest rates. So when we take this into account, things look a little different. The red line indicates 30% overvaluation, while the green line represents 20% undervaluation. These guidelines serve as boundaries, beyond which valuation is extreme in one direction or the other. When the market, which is the yellow line, trades above the red line, it is highly overvalued. When this happens, the returns over the following 10 years tend to be lower than average. Conversely, when the market trades below the green line, it is undervalued, and returns over the next 10 years will most likely be higher than average. So when the stock market went over the red line for the first time in 1968, the returns in the next few years were not that great. And this happened again during the dot-com crash in 1999, and the stock market just went sideways. Looking at where the stock market is now, and according to this, it is actually fairly valued to even undervalued, and that is because interest rates are at 0%. This is an alternative perspective, and a lot of people think that stocks are overvalued, but when we consider interest rates, the market seems alright. But the issue here is, how long can interest rates remain low? I don't know when they will go up, but with all the money the Fed is printing and pumping into the economy, inflation can go up, and hence to control the inflation, interest rates may have to go up. But for the rest of this year, interest rates will probably remain where they are. But 3 years from now, 10 years from now, then what? Interest rates will have to go up. Or we could end up like Japan with low growth, low interest rate economy, and we could go that way. But if interest rates go up, stock prices will come down. So be extremely careful when looking at this chart, because it could turn around very quickly. Thanks a lot for watching, guys. I hope you found this useful. If you did, please consider subscribing, like, comment and share, and I'll see you in the next video.